Thank you so much for introducing me, and it's my great honor to be here. And thank you, Corey is not there. Okay, thank you for inviting me to this program. And so far, I have been really enjoying this conference. So for this paper, let's change the topic a little bit. In this paper, I want to study how household wealth affect the individual's decision to work for an entrepreneurial firm. So currently, I'm in a pivoting stage for this paper. I'm trying to decide what is the direction I want to go. So it would be greatly appreciated if you have any comments or suggestions. Please don't hesitate to interrupt me if you have any questions or anything you want to say, okay? Great. So before we start, let's quickly look at the disclaimer as requested by the U.S. Census Bureau. So this paper largely relies on the U.S. Census Bureau's data. All right, let's start. Probably I don't need to stress this too much, especially in this audience, but as we know, startup firms and entrepreneurship are a key driver for not only the economic growth, but also technological innovation and the productivity improvement. And to make a startup success, one of the most important inputs is human capital. So startup is not only about the founder, him or herself, but it's about the team that use their joint effort to make the startup a long-term success. And some recent papers also show empirical evidence that losing an early-stage employees can have lasting negative impact on startups' prospect, like in terms of revenue, survival rate, and the growth rate, so on and so forth. So despite the importance of human capital to startups, it is kind of surprising that so far we don't know a lot about what drives individuals' decision to work in a startup. Potentially, there can be a lot of factors that get involved in this decision, and one of the potential determinants would be individuals' financial situation and their household wealth. So in this paper, I want to use the climate disaster as a natural experiment to investigate this question and study how household wealth affect individuals' decision to work in a startup. And here I call it entrepreneurial career choices. So some of you may wonder, okay, so why do you want to use the natural disaster as a setting? So here is the first reason. Natural disasters are economically relevant. So for example, in 2017, natural disasters in the United States caused more than $300 billion of direct economic damage in this country. And that amounts to about 2.5% of US GDP, so it is not a trivial economic loss at all. And there are a lot of high-profile disaster events in the recent decade. Two examples are here. You can see Hurricane Katrina in 2005, and also Hurricane Harvey in 2017, which hit Texas particularly badly. So both of them caused direct economic losses of more than 100 billion US dollars. So the primary direct effect of the natural disaster is actually the property damage. So among the economic losses, the biggest chunk is the property damage. And on the other hand, we know for US household, the largest chunk of asset on their balance sheet is their housing. So that is why it's natural to use natural disaster as a shock to household wealth, and in particular through the damage to their property. And another advantage of using natural disaster as a setting is that for different type of natural disasters, there will be like a geographic frontier for the area, for which area the natural disaster affected. So that would provide me with granular geographical variation in how much people are affected by the natural disaster, and hopefully can give me a relatively tight identification on the impact of their household wealth. And of course, another reason why I'm excited about this setting is because natural disaster has become an increasingly relevant and important topic in the recent years. So arguably, the increasing occurrence of natural disaster could be related to the human activity and the general climate change. So as we can see in this plot, the yellow part represents the occurrence of geophysical disasters over the year, and the blue part represents the climate-related disasters, such as the hurricane, flood, wildfire, so on and so forth. So as we can see, the frequency of both types of natural disasters has increased significantly in the last 2 decades, and most of the increase comes from the climate-related disasters. And also from the red line, we can see the economic damage also become higher and more volatile, which suggests that the climate risk and natural disaster risk has been going up in the recent decade. All right, so here is a quick preview of the study. In this paper, I want to investigate how household wealth affect entrepreneurial career choices, and in particular, I'm going to explore the granular geographic variation in the flood exposure around a set of flood events in order to achieve identification. And in terms of the data, I'm going to use individual level microdata, both on their employment record as well as on their residence location and how much they are affected by the flood. And furthermore, I'm going to shed light on the mechanisms behind this effect, hopefully, and also show some heterogeneous effect across different group of people. And the last part, we are going to talk about how the resulting career distortion as a result of the disaster experience is likely to affect the people's earning powers in the long run. All right, so first let's look at the data. So for employment history, I used the LEHD data, the longitudinal employer household dynamics data from the US Census Bureau. So this is a massive panel data. So essentially, it is a big panel at the employer-employee quarter level. So for each quarter, I can observe the the income of each individual, as well as which firm they're working for. So this helped me to track the entire job history for each individual from 2002 to 2014. And by observing the firm age, I'm able to identify which firms are startups and which firms are more matured firms. So that can allow me to track their entrepreneurial career choices in that way. And there are several advantages of this paper and make me feel advantages of this data, which make me feel that it is a particular good fit for this study. First of all, it is a large-scale data. Actually, it covered more than 95% of wage civilian jobs in the United States. And for this project, I have access to 17 states of the LEHD data, which give me a lot of variation. And also, it is longitudinally linked on both the employer and employee side. So for each single individual, I can track their job history, and so that helped me to control for the individual level heterogeneity and to see how within each individual their decision changed before versus after the shock. And also in terms of the data quality, it's a high quality data because it comes from the administrative record provided by IRS tax record. Overall, I will use this data to track the employment decision and career choices of individuals. And another advantage of LEHD is that I'm able to see a set of demographic attributes at the individual level. For example, their age, gender, education level. And most importantly, I'm able to see their residence location in particular, I can see their longitude and latitude of their residence location with 6 decimal digits. So that is a very detailed information about their residence location. So once I link the LHD data with the flat map and various geographic information system data, I'm able to tell how much exactly each person is affected by the disaster event. And the second data set is CoLogic deeds and tax record. I use this data to pin down who is the homeowners and who is the non-homeowners in my sample once I link it with the LHD data at the individual level. And the third set of data I use is a variety of GIS data. So I use this data to understand how much each individual is affected by the disaster. All right. So in terms of the event I use 5 flood events. That is the 5 most significant flood events from 2003 to 2011 within the 17 states that I luckily have access to for the LHD data. And in particular, as you can see, these are largely staggered events, happened from 2005, the earliest event, to 2010. And the red area represents the counties where the US government declared a major natural disaster associated with the flood event. And each of these events caused direct economic losses of more than $1 billion, so they are relatively large events. So to identify how the disaster experience and the resulting wealth damage affect individuals' entrepreneurial choices, I first use a regression discontinuity setting. And in particular, what I'm doing is I try to compare the individuals who live right inside the flood line and right outside the flood line in an actual flood event. So this is not about the ex-ante flood risk or the flood plain. This is about where does the flood stop in an actual event, which give us more like randomness in the exact location of the line. So to illustrate that idea, here is an example. So as we can see, this is Des Moines in normal time. And this is exactly the same location as the peak of the flood. So here, the blue area represents the flooded area. So what I'm doing is I try to compare the people who live right inside the boundary and people who live right outside the boundary, and defining the people inside as the treated group and those outside as the control group. And in particular, I look at narrow bands, which is as narrow as 0.1 miles wide along on both sides of the boundary to tighten the identification and make the two groups more comparable. So to verify whether these two groups are indeed comparable, I try to zoom in on the satellite image. So as you can see, in this location, the appearance of the house on both sides of the flood line looks very similar to each other. And more interestingly, you can, if you look at the shape of the flood frontier, it looks quite irregular and does not overlap with any physical boundary. So it further gives me confidence that the exact location of the flood frontier is likely to be quasi-random. So to further verify the whether the treated and control groups are comparable, so as you can see, here I compare the treated and control groups in a set of predetermined attributes. And for example, they are very similar in their predetermined income level, their likelihood for working for startup, age, gender composition, education, so on and so forth. And interestingly, we can see the home value. For the home value, the two groups doesn't exhibit any significant difference. And so as their flood risk. For the flood risk, the treated group experiences slightly higher flood risk, but the difference is not significant. So most of them are in the same part of the flood plain in the analysis. And also, some of you may think would it be possible that the labor market around that area is kind of like segmented, which means the treated and control groups systematically work for different group of employers? And if the employers are differentially affected, would that drive the effect? To answer the question, I test the predetermined flat risk of their employer. I didn't see any significant difference. And also their employer inundation status in the flood event do not differ significantly as well. So here is a plot where I try to visualize the impact of how the inundation depths vary in the area around the flood frontier. So as you can see, outside the flood frontier, the inundation depth is 0 as expected, while inside the flood frontier, we can see the inundation depths are positive, and also the flood get deeper when we move from the boundary into the central flooded area, which is exactly what we expected. And in terms of how the entrepreneurial quick choices changes around the boundary, we can also see out of the boundary, there's no significant change, while inside the boundary, there's a significant decline in the likelihood of people working for a startup when I compare the treated and control group. So this is verified in the regression analysis here. So here I compare the treated group, I compare the pre-post change in treated groups' decision to working for a startup and those of the control group around the shock. And what I find is the treated group experienced a significant decline in their likelihood of working for a startup in comparison with the control after the flood. And in terms of the magnitude, the propensity of the propensity to work in startup among the treated individuals declined by about 7% relative to the baseline rate of working for startups. So this is not a trivial effect, it's pretty economically significant. And more interestingly, if we look at how much wealth damage the treated group sustained, on average, a treated residents experience only about $13,000 of flood damage on their property, based on my estimation. And this is a result of just several inches of flood. All right, so some of you may also think is this really about their career choices between the startups and established firm, or it is about some people may lose their job as a result of the natural disaster, so of course they cannot work for a startup. So to understand whether that is the case, I use a different outcome variable, which is their likelihood of being unemployed. And I find the treated and control group do not show a significant difference in their unemployment rate before and after the shock. And also the treated group do not see a significant heightened unemployment rate after the shock in comparison with the control group. So this seems to suggest this is not about unemployment, this is about conditional on people having a job, which type of job they are more inclined to choose because of this disaster experience and potentially wealth shock. All right, so far, I have used a regression discontinuity setting, hopefully which can give it a relatively tight identification. However, one potential drawback is inevitably it builds on a relatively narrow, small sample. So to verify whether there's verified externality, I use DID analysis based on a broader sample. So here, the idea in this analysis is that I'm going to use elevation as a proxy for how much the individuals are affected in the flood event. And to verify whether that is the reasonable idea, I try to compare I'm going to show you two maps of the exactly same location. So here, this map shows you the flood risk is a heat map for the flood risk. So the warmer the color is, the higher the flood risk would be. So this is the ex-ante flood risk. And this is the elevation for exactly the same location. So the warmer the color is, the lower the elevation is. So if you compare these two, they resemble each other in a lot of aspects. We suggest that the elevation is indeed associated with the flood risk. And I conduct a difference in difference analysis, comparing the low elevation residents and high elevation residents within the same county before versus after the flood. So here I define the low elevation residents as those who live in an area with the bottom 3% elevation, and those and the high elevation neighbors as those in the top 3 decile in their elevation of the residence location. So what I see is, after the shock, the low elevation individuals become significantly less likely to work for a startup, and in particular, they become 4.5% less likely to work for a startup in comparison with the baseline rate. So these results confirm my previous finding in the RD setting and suggest that the finding is not just confined to a small sample, but it's likely to be able to generalize. And of course, since I used the DID analysis, it's a must to do to verify whether the treated and control groups are indeed parallel, experience a parallel trend before the shock. So here the plot shows the difference in the likelihood of working for a startup between the treated and control group. So we can see before the shock, they do not exhibit significant difference, while after the shock, the treated group becomes significantly less likely to work for a startup. And also consistent with the idea about a lasting effect, you can see it's largely progressive. So it's a little bit hard to explain by a short-term shock on their attention and effort. All right, so in the next part of the paper, I try to understand what is the underlying mechanism, as well as show you some heterogeneity in this effect. So in particular, the first question is this really about the financial damage? So one alternative mechanism could be psychological impact, right? When your house got flooded, even if you get covered by the flood insurance, you may be mentally destroyed by this fact. So could that factor into your decision of working for a startup or not? So here my hypothesis is that if this is partially related to the financial damage, we should see a stronger effect for those groups that are likely to be affected more financially as a result of the flood. So a natural candidate of such a group is homeowner. So homeowner, naturally, they are more exposed to the flood. So unlike the renters who may suffer some damage on furniture, the homeowners risk losing having their structure damaged directly, which is a much larger exposure. So what I find is the homeowner experience a more pronounced decline in their likelihood of working for a startup after that, in comparison with non-homeowners. So, of course, this does not tell us the psychological channel is not there, but at least it is consistent with the financial channel and suggests the wealth damage is likely to be one of the reasons why we see this effect. And so furthermore, I want to ask, if this is about the financial channel and this is about household wealth, how should we understand this effect? So one candidate explanation is that we know working for startup involves higher risk. It involves higher risk of unemployment in the future, and also involve higher income risk, which I can measure it using the volatility of the risk, volatility of the income. So it is possible that because of a negative wealth shock, it can lower individuals' self-insurance capacity against the potential employment risk and income risk in the startup job. So that impaired self-insurance capacity will likely to lead to make them less likely to work for a startup. So if that is the case, I would expect the effect to be particularly strong for the high-risk startup job, especially relative to their previous job. So that is what I see here. So from the column, so first 4 columns, I separately look at how low elevation and high elevation individuals differ and their likelihood of joining a startup that has a lower income risk than their previous job, and a startup that have a higher income risk than their previous job. And I found the effect is primarily driven by the latter. So this seems to be consistent with the self-insurance mechanism, which suggests that having a negative wealth shock make people less willing to take risk, and especially taking a risky job in a startup. And another potential explanation is about the non-pecuniary benefit. So we know there's a long literature talking about the non-pecuniary benefit of being an entrepreneur and working in an entrepreneurial firm. So some examples are like they may have a better sense of control or better sense of interdependence, which they may value on top of the pecuniary benefit. So if we view this type of non-pecuniary benefit as a luxury good, then one potential prediction could be the negative wealth shock make them consume less of the luxury good, such as non-pecuniary benefit in the startup. So if that is the case, I would expect the effect to be particularly strong for the startup job that provide lower pecuniary benefit than their previous job, which I use it as a way to measure how much non-pecuniary benefit the startup job could provide to the individual. And interestingly, what I found here, the effect is largely comes from the startup jobs that provide a higher income than the previous job, rather than the lower income. So this seems to be inconsistent with the luxury good consumption. So overall, the effect seems to be more consistent with the self-insurance mechanism. All right, since we still have time, let's talk about these slides as well. So to further verify whether this is about the self-insurance and the risk attitude, I try to test this question based on alternative outcomes that measure the risk-taking decision and individuals' career choices. So in particular, yeah.
So you're looking at things that happened in California and Iowa and Pennsylvania. Do they have different rules on flood insurance mandates for homeownership near rivers? Like, do some of these, do I have to in different states?
Yeah, I think that is a very good suggestion. Yeah, I believe so. Maybe I can use that to like disentangle how. So if that is the case, I would expect a stronger effect if the flood insurance is not mandatory in the location, but actually the policy vary a lot across different locations. Yeah, I will definitely try to figure out that. Thank you so much. Okay, so to further verify whether this is about the self-insurance, I use alternative measure of risk-taking in career decision. And here I examine the likelihood of individuals to work with an industry with a high career risk, which I measured using the turnover rate in that industry. And I found a similar result. I find the treated group become less likely to work for a high-risk industry in comparison with the control group in the same setting. And this seems to confirm the self-insurance mechanism as a likely explanation. All right, so in the last part, I want to study whether this really matters in the long run. Yeah.
So can I ask you a question on the previous slide?
Yeah, sure.
I just want to clarify, the dependent variable here is employment at a startup. It's not made of
this one or previous? Okay.
Your main results. It's not about being a founder, right? It's being about an employee in a
So here I do not differentiate these two because all I can observe is their income at a certain job. And typically, most of the time, the founders will also give them a self-salary as well. So they are included in the sample, but as there's no perfect way to differentiate these two groups, I just pull them together.
I'm just thinking through the interpretation. If one thinks that maybe a $13,000 wealth shot is not enough to explain why one would or would not found a company, and maybe it's psychological, it's a psychological effect or a time that's was suggested before. I mean, it might just be that, okay, the prospective founder lost $100,000 and therefore didn't found the company. And so the person who lost $13,000 or $5,000 or $2,000 is less likely to be employed at a startup because there are fewer startups that were founded.
But that wouldn't work because the people in the control group would also have less startup opportunities to be there. Now, it could be that I'm $13,000 poorer, and so I'm less willing to be the 12th employee at, the next version of Bumble.com, but
again, it's more consistent with this, what you're saying about things like self-insurance. So I'm less likely to want to be employed in a high-risk setting.
Yes.
Rather than the lack of personal wealth makes me unable to found a company.
Yeah, so based on the current finding, we cannot differentiate these two, but I did do a partition analysis on whether this effect comes from funding the business or the becoming employee using wage as a proxy for like the top few earners. I approximately call them founder in my data. So if I do that, I find the effect largely comes from the employee. But the sign for the founders are the same, but it's just because it's a much smaller group, I doubt that I have enough power to detect that. But yeah, I think it's kind of speak to your thought that this could largely be driven by the lower self-insurance by the employee rather than the funding decision.
And since you have census data in your individual fixed effects, you have marital status and number of kids, right? Because that would affect my risk-taking.
I would love to have that data, but unfortunately, I do not have that due to some census restriction on what are data you can merge together in the same project. But I think I do have some other ways to proxy for that, like using age, and also I have a proxy for marital status. Maybe we can try to do something at the end to control for that. Yeah, so what's on your mind? Why do you think it would be interesting to control for that?
If I have 2 kids and I'm married, I'm far more likely to try and take a stable job after my house is flooded than if my house hasn't flooded.
Okay.
Or if I'm single, my house is flooded, I'll go rent an apartment.
Yeah, so there could be some heterogeneous effect across different groups, right? Yeah. Yeah, I think that's interesting to see. I will see whether I can get the data or come up with some reasonable proxy for that. Thank you.
Are you done with your talk?
No, actually, I'm just checking the clock to see how much. Yeah. Great. So in the last part, I want to test whether the career distortion as a result of the disaster experience really matter in the long run. And my hypothesis is that because experiencing a disaster seems to make people less willing to take risk in their career. So if we see the career risk as positive correlated with the reward you can get from the job, it potentially can impair people's earning power in the long run. And indeed, that is what I found. So I look at 6.5 years after the shock, which is the maximum period I can check based on the data time span. And what I found is the treated group earn a significantly lower income in the 6.5 years after the shock. And the quantity of this effect is also non-trivial. So I found $1 estimated property damage is likely to translate to 62 cents of income loss in the period. All right, so let's wrap up. So in this paper, I find even modest wealth damage from the natural disaster can significantly discourage people from working for a startup and discourage them from an entrepreneurial career. And I also find this effect is particularly pronounced for homeowners, which is consistent with the financial channel. And further analysis suggests the effect is likely to be driven by the impaired self-insurance capacity, which make people less willing to take a risky job in a startup and also other type of risky job. And overall, the career distortion as a result of the disaster is likely to lead to a long-run impairment in people's earning power. That's it. I'm happy to take more questions or any comments.